All right, guys, welcome back to the Independent Investor Channel. I always like to roll these out on occasion with the market at an all-time high where I'm seeing value in the market. These are all companies that I own. I'm going to roll out 12 companies that I feel like are undervalued at this point. We're going to go through them quickly. I'm going to provide these in a basket portfolio that I'm going to provide in the comments section below. You guys are welcome to click in there if you fail to record these, or if you forget one. It's no big deal. These are all great quality companies. No real surprises here, other than the fact that it kind of surprised me a little bit to see some of these on the list and metrics that I use in evaluating fair market value. And some of these may surprise you guys, others may not. I think some of these are part of sectors that are out of favor right now, and that's totally fine. We're going to continue to be patient. I think the theme in all of these is absolutely a nod toward growth and not toward value. So some of these that are nice established businesses that are paying a nice dividend in the value category are kind of being brushed aside here. And I think that's a real mistake. I really do. I think each and every portfolio out there, if you're looking to omit value from your portfolio, I think you're really running the risk of disappointment, especially if the stock market decides to take a nosedive on us. These are the companies you want to own defensively. Okay. These are the ones that you can own through a recession. These are good companies that have been around. They've paid a good, consistent dividend for many, many years. Now, if you're 20 years old, do you need to have the majority or the lion's share of your portfolio made up of these? I think not. I think the whole point of this video is to earmark where value is, and value ebbs and flows in and out of the stock market. And I think what is in favor right now may not necessarily be in favor 6 months ago. So it's going to benefit each and every investor to take a hard look and always continue to comb over the stock market for value. All right. And the first on the list, which is the most undervalued according to the metrics that I look at, is Citigroup. It's currently trading at a 26% discount, even with the run up. It's currently trading at about 61.33. It's one of two financials that I have here on the list. Financials have really made a run up. Citigroup has participated in that run up. But fair market here, trading at a discount of around 26%. I don't think there's a finer domestic play, yes, Citigroup, that has its exposure to international markets. And I'm looking at the Bank of Nova Scotia, and it was amazing the similarities between the two. Bank of Nova Scotia is the third largest bank in Canada, but it has the most international exposure. And I thought right away to Citigroup here domestically in the US, but a great dividend yielder, and trading, according to the metrics I looked at, it as a nice discount here. Next on the group is one of my absolute favorites. This is Pfizer. Ticker symbols PFE, trading at, again, around a 27% discount here in the healthcare sector. Always a good name to be added to the mix here when you're talking about value. And if you were wondering about the stock being undervalued at this point, it absolutely is. So Pfizer is definitely a name to take a look at here. Next on the list, we've got, let's cruise down the list. This was a surprise to me. This really was. I've owned Alibaba Group for a while now. I've made money on Alibaba every single time I've owned it. It is, I consider it a discretionary name, really. I put it up there with Amazon, but it is listed here as a technology name. Nonetheless, it is undervalued. Fair market on Alibaba puts it up over 300. It's currently trading at a significant discount to that, at about just over 23% of the discount for Alibaba. So absolutely worth taking a look at. I took it on a swing trade all the way up. It ran up and had a big run up day. I took some profits there and rolled back in some of the profits to 10 more shares, a little bit smaller position than what I originally had. But Alibaba absolutely makes the cuts on the list here for value. And the next on the list, two completely different companies here, is my absolute favorite in the defense sector. This is huge. Lockheed Martin trading at 16 times is kind of stupid, to be honest with you. This is a company that can be a cornerstone in any portfolio in the industrials and transportation subsector of industrials. Lockheed Martin has it all: government contracts, and I can't for the life of me understand why this stock currently is trading at a discount. It's supposed to do well under the new administration. I don't know why that has a big deal. I would have thought with the support of the defense systems, writing government contracts, etc., that Lockheed Martin would flourish under either administration. But I think right here at 340 is stupid. I can't wrap my head around this one. I'm almost tempted to take another strategic buy in this name here at 340, because honestly, if it continues to drift down for no reason, which stocks do sometimes, then no problem. I can live with that entering into a fine company. I've got this whole girl valued at up over $400 here in Lockheed Martin. So just an absolute beast. And you can kind of see here the diversity across my offerings. That's the only one out of industrials that we're looking at here for the value play. Next two on the list here, right back to back. This was a surprise to me, but Salesforce.com is making money hand over fist, just newly added to the Dow Jones Industrial Average batch of 30. We lost ExxonMobil out of that group, but Salesforce, valued at around 275, puts that at a discount of around 22% right now, trading at around 226. It was at 250 for a while. You can get it here on a nice channeling opportunity, as it's been kind of on the low end of the range here at 226. I don't think it's going to remain there for very much longer, but absolutely technology on the software side of the house for Salesforce. And next on the list is Bristol Myers Squibb. This is one of my favorite cancer. I own 50 shares of it, but their cancer treatment, oncology, they're really in a lot of different businesses when I studied up on this. But the ticker symbol BMY, trading at a discount of close to 21.5%. In healthcare, the pharmaceuticals sector, say no more. Bristol Myers is a great cornerstone in any portfolio. I own it myself. One thing is in common: I own every one of these. Yes, I do. So put your money where your mouth is, YouTube. That's kind of my whole philosophy. Doesn't mean that you have to go and trip over yourself to jump into these names next week. What it does mean is that, I come on and I assess the market constantly, and these are just the pockets of value here. I own every one of these. So the question is, do I add more to it? Do I continue to allow a position like Citigroup that's already run up continue to go? If it comes back on me, I'm okay with that. The idea here is to earmark where I'm seeing value for you guys, and this is just where I see it. The next on the group here is Facebook, and unfortunately, this is kind of run up off of. It gave a nice buying opportunity at a 250 range, but I think Facebook, I believe, just had a MAC crossover, so I look for the stock to move quickly up to 275. Fair market on Facebook at 321 puts it at about a 17% discount right here. Facebook is one of the best companies that I see out there. If you were looking to add, what unfortunately is earmarked as a telecommunications company, I personally don't like to tag it that. I like to tag it as a technology company. It just seems to fit better. Nonetheless, Facebook absolutely made my list of value here. for you guys to take a look at. Next on the list would be Altria Group, MO and the Staples. This is a money-making juggernaut. They pay a lot of their earnings out in dividends, which is somewhat concerning, or would be across the board, but in this particular case, not so much. They are the domestic play. I do own Philip Morris, which actually I'm a little more bullish on and would have actually made this list. But I think at $41 a share, Altria Group actually proved to be a little bit better discount, just shy of 16% of a discount premium, where it's trading at right now, just shy of $42 on the open market. So Altria Group is right there. And I just think it's a screaming buy. Kind of put that into the holy crap, I can't believe it's this inexpensive category, along with Lockheed Martin. But hey, sometimes that's exactly what happens. Next on the list is IBM. IBM just got whacked. I don't quite understand. IBM is not for those young investors looking for sleepy money or dead money or whatever you want to call it. IBM is a good 5% dividend payer, trading at a discount still at 15.5% here, trading market value 119. I've got this targeted at 137 in the IT and services and computer in technology, but I like IBM. I always have. I have no problem owning it. Gives me a little niche of technology exposure. I don't own it exclusively, but I do own the shares, and I believe I've got about a 25 share block in IBM. Nothing crazy, but do own it nonetheless because the value's there. It's just that simple. All right. Next on the list is McDonald's. Very, very important. McDonald's is one of my favorite companies in discretionary. Discretionary is a tough sector to fill. And some of the companies that do go into discretionary for me, being Leggett & Platt, McDonald's, Home Depot, as well as Amazon, and then Alibaba, which I kind of put in discretionary as well. McDonald's is fantastic, great dividend payer, great company to own for the long term. Currently trading at a discount from the best I could see from the metrics that I look at here at about 11% discount. Nothing too crazy, but at its current price in the market, 213 at a target of 238, not too shabby there. And everybody's saying, well, the market's at an all-time high. Yeah, well, this is just the pocket of the market that's getting ignored right now. And I'm not entirely sure why. AT&T is next on the list here after McDonald's. AT&T, not quite such a discount. It ran up there for about a day, which AT&T typically does not do that. It traded like a penny stock for about a day, ran up, and it fell all the way back again. So it's back again at 28, screaming at investors, just shy of 29 to be specific. It's screaming at investors to pick it up, pick up the 7% yield here. And at a fair market value of 32, we're looking at a discount of about 11%. But AT&T always floats to the top of my watch lists here. Super important to always kind of keep an eye on anyway. But one that I'll own long, I own over 300 shares, and I continually roll my premium contracts on AT&T forward. It's just easy money to be made there on a stock that I look to hold long anyway. So good to go there. Next on the list here is a surprising one, and this one will surprise you guys. But Amazon is starting to become stupid undervalued. Okay. Now it just recently ran up. It hit some support there and it just bounced, because anytime Amazon gives investors an excuse to jump into the name, you're going to find that it is bought. And that's exactly what happened. Amazon right now trading at about a 14% discount, stock price just shy of 3,300. Amazon's not for the faint of heart. But I think if you were just going to buy the absolute best online retailer, you might want to just argue with me and find another company better than Amazon, but I don't think that you will. And I deliberated on owning Amazon for a long, long time. Price to earnings ratio, price to itself, has really come down, and it's making killer cash. But Amazon is a really, really good one and discretionary, and according to what I look at here, slightly undervalued on the metric scale. The last one I'll mention is also in financials, along with Citigroup that I mentioned at the top of the offering. JP Morgan is my absolute favorite. JP Morgan falls into the stocks that you can buy and own forever, and it's still there. It's one of those companies that can be a cornerstone in financials. It's the best run bank. It's the largest bank in the world. It's fantastic. Make great products, great financial services institution. It's a company that I own and have owned and will continue to own into the future. But right now, JP Morgan is also trading at somewhat of a discount here, and it's absolutely worth looking at. About a 7% discount. Unfortunately, financials have kind of run up a little bit, so these optimal entries have kind of come and gone. But JP Morgan absolutely rounds out the list to the top 12 areas representing the best value in the stock market right now. Sometimes you got to zig when the market zags, and everybody else has got their focus on everywhere else in the market. I'm there too. I'm in growth, no big deal. But some of these names have been left for dead, completely forgotten. And I think there's going to come a time here in 2021 when people are going to have to pay attention to value and the defensive names again. And that was the predominant listing in these undervalued companies that I shared with you today. If you enjoyed the message, guys, and make sure and subscribe to the message. I will share this portfolio as well in the comments section. You're willing to kick over there at your own leisure, do your own due diligence, check out the picks that I'll offer for you in a very, very simple listing. That way the 12 undervalued companies that were chronicled in this video will be available to you at your leisure. And make sure and leave your comments at the bottom, share the message with anybody out there, and bring them onto the community. Share what we're doing here, sharing the awareness piece to everything stock market investing and building wealth for individuals. All right, guys, thank you so much for tuning into this message.